From Deloitte Tax and Legal Japan, welcome to the Japan Perspective. This is a podcast where we speak to specialists from across Deloitte to discuss the latest business issues impacting foreign multinational companies in Japan. I'm your host, Joanna Hazel. Now that we've entered into 2024, we're going to kick off the first podcast of the year talking about the new 2024 tax reform proposals that have been announced. This will be the start of a series we'll do on the new tax reform. Today, we welcome back Brian Douglas as our guest to start off this series. As a reminder, Brian is a managing director with the Business Tax Services team with Deloitte in Tokyo. Brian will also be a speaker in a webcast that the Deloitte Tax team will be hosting on February 15th. So please be sure to register and tune into that webcast as well. Now, before we dive into this episode, the tax reform proposals were released by the Japanese government in mid-December of 2023. So we'd like to emphasize that these are currently just proposals, and a few details could change prior to being enacted. And things are hopefully going to be enacted sometime towards the end of March. Now, let's jump right into this episode. Over to you, Brian. Thanks for joining us again.
Yeah, thanks, Joanna. So as you're aware, there are many proposals in this tax reform package, but I think we can bucket the items that we're going to talk about today into three general themes. One is proposals dealing with the gap between inflation and slow wage growth. Another one being proposals around encouraging companies to invest in Japan in production and develop IP here in Japan. And the third around ensuring compliance and preventing abuse. And it's with the third one I'd like to start today and talk about some changes to the local enterprise tax, which is a tax imposed by the prefectural governments here in Japan. As background, the local enterprise tax consists of two separate taxing regimes. The first regime being a tax imposed on the income generated by companies, and the second regime being a three-factor tax, where there's an income levy, a levy on something we call value-added component, and a levy on the capital of a company. And the second regime is aimed mainly at large companies, with the idea being that even in bad economic times where companies may produce a loss and not pay any income tax, the local governments will still be able to generate some tax revenue from the capital levy and the value-added levy, at least from large companies.
Gotcha. Can you clarify for us how exactly a large company is determined?
Yeah, so that's determined based solely on the amount of the company's stated capital. So if a company has stated capital below a certain threshold, it'll be subject to the first regime, the income-only regime. If the stated capital is greater than that threshold, then it is subject to that three-factor regime. And in Japan, it's been fairly easy for companies to reclassify their stated capital to another type of capital within their balance sheet, called capital surplus. And so you can imagine a case where there's a large company that's going to generate a loss. It may be incentivized to reduce its stated capital and shift that over to capital surplus and push itself into the first regime of the enterprise tax and not pay any enterprise tax for that year. And in fact, some companies have taken advantage of that. So the first part of this proposal is to address this issue by redefining what is a large company. And they do that by looking not only at the stated capital of the company, as is the current rules, but look at both the stated capital and the capital surplus to determine whether a company is subject to the first regime or the second regime, thereby making it really moot for companies to shift between the two different types of capital.
Got it. Okay, thank you. You mentioned that that's the first part of the proposal, so that might beg the question, what exactly is the second part of the proposal?
Yeah, so the second part really addresses a different issue and focuses on subsidiaries of large companies. So even if a subsidiary has a small amount of capital, the idea is that it may benefit from being part of a group where the parent has a large amount of capital. And therefore, for enterprise tax purposes, shouldn't we treat that subsidiary the same as a large company and subject it to the three-factor enterprise tax? So the proposal is going to require that the subsidiaries look not only at their own capital, but also look at the capital of their parent company to make a determination of which regime they will fall into. So we may see many companies whose parent companies have a significant amount of capital being pulled into this three-factor enterprise tax regime going forward.
I see. Before we move on to the next little theme you were talking about, is there anything else in terms of ensuring compliance that our listeners should know?
Yeah, I think so. I think there's a couple of proposals that relate to Japanese consumption tax that fall within this bucket. And the big item is really around the taxation of platform operators, and specifically platform operators that facilitate the sale of digital services from non-resident suppliers. So you can think, music downloads, streaming services, online games that are provided to Japanese consumers through these platforms. Well, currently, the obligation to collect and remit consumption tax and to file a consumption tax return lies with the non-resident supplier. However, the tax authorities have had some difficulty in enforcing this at times. And so the proposals are going to switch the obligation for the return, filing, and the JCT remittance from that non-resident supplier to the platform operator, at least for the larger platform operators. There's a couple other proposals, within the realm of Japanese consumption tax, and one relates to preventing foreign enterprises from taking advantage of the flat rate regime, which allows them to take a deemed input credit, even if they don't have a permanent establishment in Japan. Another change is around whether an enterprise must remit JCT and file a consumption tax return, with the aim of ensuring that foreign enterprises aren't able to take advantage of certain perceived inequities in the system.
So it seems like the government is focusing on creating somewhat of a level playing field to ensure compliance. And you also mentioned their new incentives. Can we switch gears and talk about those a bit as well?
Yes, so a couple of new incentives in the reform proposals. One relates to strategic goods production. So this is aimed at the manufacturing of certain types of goods that Japan thinks are in its long-term security and economic interests. So for example, this would be semiconductors, electric vehicles, green steel, green chemicals, and a few others. And the benefit will be in the form of a tax credit based either on the cost of the acquisition of assets and equipment to produce these goods, or on the output. So a fixed amount of credit for each unit that'll be sold. The other new incentive that's in the proposals is Japan's version of an IP box. So this is primarily aimed at IP related to AI. And the benefit is a reduction in the IP generated income that's subject to tax. So in effect, companies may see this type of income, at least the effective tax rate related to this income, drop from 30% to 20%. However, it appears that IP income from related parties is excluded. Therefore, this IP box may be less beneficial than IP boxes you might find in other jurisdictions.
I see. I know that when I was reading through some of these new proposals, I read something about incentives for research and development. Is there any chance you can talk through a little bit about R&D incentives as well?
Yeah, there's a number of proposals to existing incentives, including the R&D tax credit. And related to the R&D tax credit, the proposal really is trying to discourage companies from reducing their R&D spend. So if companies reduce R&D spend, they'll get less of an R&D credit, and in some cases, maybe no R&D credit. Related to the carbon neutral tax incentive, for companies that are investing in assets and equipment to improve their carbon productivity, that is the output per unit of carbon emission, the threshold to qualify for that incentive is actually going to become more strict under the proposals. And finally, and this next incentive, while it's an incentive, it also relates to the first theme around inflation and wage growth, and it deals with the wage increase credit, which allows companies a credit who increase their employee wages above a certain amount. So this has been around for a while, but the proposal is going to make it easier and more beneficial for companies to apply.
Right. Okay. Thanks for that, Brian. Now, for those listeners that tuned into our Pillar 2 episode, know that Brian was our guest speaker for that as well. And I'm wondering, Brian, I think Pillar 2 is announced that it was going to be implemented from April 1st of this year in 2024. Is there anything else in the proposals or any update on that, or things that from an international perspective our listeners should focus on?
Sure. So with respect to Pillar 2, nothing concrete other than an indication that the qualified domestic minimum top-up tax regime will be considered in next year's proposals.
Okay.
The proposals were silent with respect to Pillar 1. And the only other, I think, international tax-related item to note here is there is going to be a temporary extension of the carryover period for any excess interest under Japan's earnings stripping rules from 7 to 10 years. So companies with non-deductible interest may have more opportunity to recover that in the future.
All right. Well, thank you so much. I think that brings us to the end of today's episode. As a reminder, our team, Deloitte Tax Team here in Tokyo, will be hosting a webcast where we dive into more of these tax reform proposals deeply, and Brian will be a speaker there. The webcast will be on February 15th, and the registration link you can find in the description of this podcast. So please do tune into that. And like I mentioned before, this is a start on a series of the new 2024 tax reform proposals, where each episode will dive a little bit deeper into some of the new proposals. So thank you, Brian, today for giving us a little bit of a preview of what people can expect in terms of tax reform proposals. And in the meantime, if any of you have any questions, as always, feel free to reach out to either of us on LinkedIn, and we'll see you next time. Thanks, Brian.
Thank you.